You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome to the Infinite Banking Mastery Podcast. I thought I would touch on the topic today of different policy types, the pros and cons of these different policy types, and why or why not they would be a good fit for the infinite banking strategy. So the type of policy I've been talking about and continuously referring to since I started this podcast is whole life insurance. This is the absolute best type of life insurance to use for this purpose. Why? Because it has guarantees in place, and for most people is guaranteed to grow. Now, the reason I say for most people is because if a person is in their late 60s or 70s, and depending on the health rating, the guarantee will still be there, but the growth might be minimal. There are ways to design the policy to help the cash grow as efficiently as possible. It's just that it will certainly be less dazzling than it would be for a younger person. Of course, there are a lot of benefits to a whole life contract other than the growth and the uses of the cash value. And so someone in that age group might still find a policy beneficial due to, for example, the chronic rider, which I've mentioned before, that would allow access to the death benefit if they were unable to perform 2 out of the 6 activities of daily living. The 6 activities of daily living are eating, transferring, dressing, toileting, continence, and bathing. So if you have a whole life policy that comes with this rider and become in your lifetime at some point unable to perform 2 out of those 6 activities of daily living, you would be able to then access up to 50% of the death benefit of your contract. Of course, there are chronic and terminal illness riders too. With the chronic rider, you would be able to access up to 25% of the death benefit if you were to have a chronic illness. Some of the illnesses on that list are things like major heart attack, invasive life-threatening cancer, a stroke, or if you were to end up in a coma, things like that. And of course, the terminal illness rider, which would allow you access to up to 70% of your death benefit, is available if you are given 12 to 24 months to live, depending on the policy and the company. Whether or not you live beyond that time frame doesn't matter. It's just that if you are given that prognosis that you have 12 to 24 months to live, then you have access to up to 75% of your contract. I know, depressing topic. These features that come with the policy, in addition to being able to care for your loved ones by leaving them a death benefit and having control of the cash value inside of your policy to do with as you please, are reasons why older clients do still like to acquire these contracts. These features that come with the policy, in addition to being able to care for your loved ones by leaving them a death benefit and having control of the cash inside of your policy to do with as you please, are reasons why older clients still like to acquire these contracts. We would just have to take a look at what your goals are that you have for the policy, your budget, your health rating, and then see how we can build a plan that fits your needs. Okay, that was a bit of a digression, so let me get back to the original topic. I had said that the best policy to use for infinite banking is a whole life policy, hands down, and it's because of the guarantees that come with that policy. Therefore, making it a much safer policy to be borrowing against and pulling funds from in your retirement years. There is another policy out there that is very popular right now, and that some are trying to say is good for infinite banking. It is the Index Universal Life Policy, or some call it the Equity Index Universal Life Policy. There are different names out there for it, but it's the same thing, really. In my first podcast on how infinite banking became my passion, I touched on how I met an agency manager who introduced me to the world of cash value life insurance. When I met him, he asked me, just what in the world are you doing in this assisted living world with all of these licenses? I told him, I just didn't feel like I was truly able to help people where I was. I wasn't 100% confident that I could actually help them meet their retirement needs when I don't know what's going to happen in the market tomorrow, and neither does anybody else. With what happened in 2008 to so many people's accounts who were about to retire and then they just weren't able to, it just didn't sit well with me. And so I decided to step out of the industry for a moment. I just felt like, how could I really tell these people that I care about that I'm going to help you reach retirement? And here's what we're going to do to reach your retirement goals, do all our due diligence, make sure everything is good and solid, and then say the accounts do amazing for however long, 10, 20 years, or whatever. And then they retire. But right before they retire, the market tanks and they lose half. It just didn't sit well with me. And so he said, well, you just didn't learn all the ways to help people. And then he shared with me the life insurance strategies that he was using to help people. So this was the type of policy that I was first introduced to, the Index Universal Life, or IUL for short. I was very excited about this type of policy when I first learned of it and shared my excitement with anyone who would listen to me, because your funds were protected from a stock market crash. And that was a big deal to me. I ended up with 6 of this style of policy for myself, my husband, and my 2 kids. It wasn't until I met my mentor, Joe Pantozzi, who opened my eyes and mind to the infinite banking concept, that I realized how much more powerful IBC is, and that a universal life policy should definitely not be used for the banking strategy. Nelson Nash was vehemently against an index universal life policy for IBC. And working with Joe and learning from Nelson, I was told and reminded regularly that an IUL should never be used for this strategy. In fact, IBC practitioners certified by the Nelson Nash Institute have been strictly told never to use an index universal life policy. You may be asking yourself why, especially if you don't have any understanding of these types of policies. What exactly is this type of policy, and why shouldn't I use it for my banking system? Some of you maybe have heard a lot about this type of policy on all sorts of TikTok videos, Instagram shorts, and YouTube videos. I have seen and heard a lot of information online myself, a lot of which is true information and a lot of which is not true information. This type of policy is basically a term policy paired together with a savings component. These policies come with a lot of flexibility for both your premium and your death benefit. So you can easily increase or decrease your premium payment. You can also decrease your death benefit. They were really created to allow people transparency into a contract and to allow them more flexibility. And in addition, to see all the costs separated out and also the interest earned separated out. Whereas with whole life, it's all wrapped up into a nice little bundle that you cannot dissect, or it's also not as flexible as universal life. There is some flexibility, but not nearly as flexible. So another very different feature is how these policies credit interest. They are tied to an index. A very common index is the S&P 500. In case you didn't know, the S&P 500 index monitors the stocks of the top 500 companies in the nation. And so your interest earned reflects what the index has done in the market. There is a floor, commonly at 0%, and also a ceiling or a cap. This cap can change annually, and it often does. So you would receive the amount of interest that the index did between a floor and a cap. The caps are always changing. I would say right now that caps on most products are somewhere between 8 and 10%, could be a little higher, since interest rates have been just higher this year. When this S&P 500 index is selected within your universal life policy, your index universal life policy, it means that you will receive interest once a year on your contract's anniversary date based on the performance of that index. It does not mean that you are invested in the index, but instead merely applying the index's performance between the floor and the cap to your contract. Let me give you an example. Let's say you have a contract that has a 0% floor and an 8% ceiling or cap, and that you selected the S&P 500 index as your crediting strategy. A year has gone by on your contract, and it is now your anniversary date. Let's say the S&P 500 index increased 5% from the first year to the second year on your anniversary date. And because the rate was between 0 and 8%, you would receive the 5% credited to your policy. Now, let's say the S&P 500 lost 30% that year. Well, your funds would be protected because you have a 0% floor. And if the rate ended up being 20%, you would only receive 8% because that is the cap. So upon first glance, the major pro with this type of policy is that it is guaranteed never to lose money, even if the market tanks, but that you still have the possibility, the potential for some pretty good upside. It was this inability for the cash value to go below zero that had me so enthused about this product when I first learned about it. These types of policies also can come with the same critical, chronic, and terminal illness riders that I mentioned earlier, and also can be borrowed against and accessed tax-free all of your life. Although the loans do work a little differently. Sounds pretty good, right? The funds are protected from market losses with the possibility to receive a decent interest rate each year. All the good riders and the ability to access your cash when needed. However, after a few years, and once I really started diving into my IBC and whole life learning, I started to learn more about the potential for the policy to lapse in the later years. I hadn't realized at first that the life insurance component of these policies was basically a term policy that increased in cost as you age. So they could be doing really great to most of your life. And then once you hit your 70s or 80s, the cost goes up and there's a real risk of losing the policy. Most people aren't aware that the cost is rising inside of the contract because they continue paying the same premium that they started with. And as the cost increases, the excess cost starts to draw down the cash value. For example, let's say you started one of these policies at $200 a month in your 30s. Now, this is a super rough example because I'm not stating the death benefit, the exact ages, the health rating, any of that stuff. Okay, so the cost of insurance would be pretty low, like the mortality costs, the actual cost of maintaining the death benefit, like maybe $30 a month or something like that. However, when you're 75, the cost of insurance jumps right up to something like, okay, I'm just pulling numbers out of thin air here. Let's say something like $400 per month. Then over time, it goes up more, maybe $500 a month, or at some point, $1,000 a month. It just keeps going up, up, up as you increase in age. So that extra cost ends up coming from your pool of cash, unless you decide to pay the extra cost, which again, most people are not even aware of until it's too late. And that cost will get a lot larger the older you get. You can certainly increase your premium to keep up with increasing costs. However, most people are very frustrated when they realize what has happened. The idea and the intention behind this type of contract is that the cash value will do so well, or that you're funding the contract to the maximum, like you maybe intended in the beginning, that you won't notice the increasing costs because it's just doing so well. However, nobody has a crystal ball to know if the market will do consistently well into the future. And either way, I imagine you wouldn't want your cash value being eaten away by the increasing costs inside the policy. I have received clients who have lost their agents, as in their agent left the business, who have been saving into these style of contracts for years and years and expect there to be a nice chunk of change inside for them to access. Or at the very least, expect their premium not to increase or to remain the same. And they are confident that they have a permanent life insurance contract. In fact, I just spoke to one of these clients just not that long ago, and she's had her policy since 1990. She was telling me her contract was good and safe and that she had plenty of cash in there. She wasn't worried about it. She didn't even want me to take a look at it. However, I kept insisting that it would be a good idea for me to check it out. She had to make me the agent of record on her account in order for me to be able to see it. And I quickly saw that there was $0 in the account. So I requested information from the company to see if her contract is at risk of increasing in price. And lo and behold, it will be lapsing within a few months unless she increases her premium by about 1,300%. That's right, I said 1,300. And that new price would still not guarantee her policy would stay in force beyond 9 more years without increasing the premium again. In addition, the life insurance company is also able to increase the cost of the units of insurance to a stated maximum regardless of the aging factor. I've had this happen to a client as well. He had a contract on himself and his children and received a notice that the internal costs were increasing on his child's policy. And the amount the company was increasing to wasn't even the maximum. They still had room to raise the rates even more, raise the cost. So you have the potential to have the cost raised per unit of insurance, and the cost will go up as you age. It is because of these risks that this type of insurance is not a good fit for the infinite banking concept. Because we want to be able to foresee with certainty that there will be guaranteed cash in your policy until the day you die. Rather than, well, we hope you follow through with maximum funding of the policy over your lifetime and that the index you've selected and the market does well enough so that you have cash in your policy despite the increasing costs. Okay, so I've gone over the more popular index universal life policy. There are also regular universal life policies that operate in the same way. They just have different ways that they are credited interest. And also there are variable universal life policies. The acronym for that is VUL. These two operate in much the same way, except that instead of referring to the performance of a selected index and then crediting your policy between a floor and a ceiling, you are able to select funds that are directly invested in the market. So those funds can go up or down like any funds. They can lose money just like anything else invested in the market. And people might like the idea of investing their cash value into investments that they choose. However, due to the volatility of the market and the additional cost to these types of contracts, we believe they are just not a good fit for infinite banking. Just too risky. When it comes to my banking system, I want a solid policy with guarantees in place. For me, I prefer to keep my life insurance and my investments separate. Universal life policies were created to give more transparency to all the costs and the gains and what's going on inside of a life insurance policy so that you could see all the moving parts. Although IULs and VULs release the company from the risk of having to grow the money for you, and instead they are turning over that risk to you, the policyholder. Whole life has been around for over a century, whereas universal life is a newer vehicle created in the late 70s and early 80s. The original universal life contract was more like a whole life contract, just more transparent, so that you could see all the moving parts. And also they gave the ability to change different features like the premium and the death benefit. You can even skip premiums for a period of time with these types of contracts. The original universal life contract was more like a whole life contract, just more transparent so you could see all the moving parts. And then they gave much flexibility to the premium. You can even skip premiums for a period of time with these types of contracts. Soon after the original universal life contract came to the market, they introduced variable universal life to give clients an opportunity to earn higher gains within their policy. And then they tried to improve upon this vehicle again by creating index universal life. So now that I know what I know, and after nearly 2 decades of study in this industry, and trust me, I'm studying all the time, I want the growth in my life insurance policy to be guaranteed, end of story, and to have been around and proven longer than 40-ish years. Using a whole life policy is what Nelson Nash recommended and insisted, actually, and it definitely does make the most sense for a banking system. I've always heard it explained this way. Whole life has guaranteed cash, as in guaranteed cash for you, and it is stated in the contract, versus guaranteed cost. And this is referring to the maximum guaranteed costs that the company can charge you. So to wrap up today's episode, I have a funny story for you. It has to do with my first infinite banking client that I ever helped. So I got together with this couple who was referred to me by a friend and client. I got together with this couple and sat down with them. They wanted my help. They had wanted to ask me over. They wanted me to look at everything they had. So I was understanding their financial situation and just reviewing everything. And then towards the end, I got into a little bit of describing, some of their options. And I did introduce this index universal life strategy that I was just talking about to them. I just went over some basic information about it and just kind of described in general some of the stuff about it. And then the wife started to get, interested. And so she was asking more about it and she liked it. And she said, well, is this the best thing we could do? And, there was other things I was planning to share with them to help them choose. But she was asking me, is this the best thing we could do? And so I paused for a moment and then I looked at her and I said, this really isn't the best thing you could do. And I just learned of this other strategy that to me is the most amazing thing. And it blew my mind wide open. And I think everybody should learn it. And I think that's probably the best thing you could do. But I can't teach you. I just learned it myself. I'm still learning it. I'm not able to teach it to you. Luckily, I am partnered with one of the best in the nation who can teach you, who's been doing this, one of the longest in the nation, and who's just an awesome mentor and advisor. And I know he can help you, but he won't even talk to you unless you read this book, Becoming Your Own Banker by Nelson Nash. So she just looked at me and was probably thinking, what in the world? This woman was just telling me, about this other strategy and these other things. And now she's telling me this is not the best thing I could do. She probably thought it was crazy, but she said, okay, yeah, I'll read that book and then we can talk about it. I told her, if I were you, I would read this. I would have the meeting just to learn what the option is. If it's not for you, that's fine. We can do something else. We can do anything else. We can do this strategy I already shared. We'll work it out to make sure it's the best fit for you and your needs and your goals. But if I were you, I would at least have the meeting and understand this other option. And so she did. She took the meeting, her and her husband, and they've been clients ever since. And they've been great clients, and their policies and their banking system is doing well. So I just like to share that story. I thought it would be funny, just me telling her, hey, here's one way we can go. And now just kidding. Let's go this other way. You should do this other thing instead. This is better. So that's all I have for you today. If you would like to connect for my help with building an awesome life insurance strategy fit for you, please reach out to me at Valerie@alphaomegawealth.com. I look forward to sharing again with you next time. As always, have a great week.
This is thepodcastfactory.com.